G'day. I've been meaning to record this video for quite some time because I get asked all the time about what's better for, usually for investors, interest only or principal and interest. And I suppose what the term better is, what that means to each individual person is different. So better cash flow, better savings, better money management, better rates, whatever it happens to be, better does mean different things to other people, so to different people. So I think it's what it's important is that we can sit down and work out what the facts are, and then make a decision off that. Um, Generally speaking, interest only is for investors. Very rarely it's for owner occupiers. Owner occupiers could get interest only if they've got and this is for regulation purposes, but if there's like a short term reduction in income or a short term increase in expenses. So, for example, a construction loan, you might have to be temporarily renting somewhere while you're waiting to build. Maternity leave, you could be short one income for a period of time. So there are reasons there, but both of those examples, though, you pay a higher rate and you're basically not paying anything off your loan unless you opt for extra payments. So both of those, it's going to just cost you more and that's it. But the cash flow in those instances are probably more important. So this is purely aimed at investors, trying to work out what might be better in terms of choosing the two. So let's jump straight into it. I've created a spreadsheet. It's quite a busy little spreadsheet, but and by the way, you can ignore all of the calculations I'm going to go through. I suppose this is aimed at those that love to know the nitty gritty of how things work and how we arrived at certain figures. So so this is really sort of aimed at all investors really, but in terms of going through the figures in more detail. So I'm going to work in reverse. And then I'll actually go through how I worked out the figures. So those that don't want the detail, you can switch off and you don't have to worry about the rest. So working in reverse, basically, if you choose an interest-only loan, it's generally, what are we, the 19th of July, 2022. At the moment, it's about 0.2 to 0.3 more expensive for an interest-only loan than principal and interest. I gave you that date because at one stage it was 0.5 more expensive. At once that I went 5-6 years ago it was the same rate. So that can change. If it's the same rate, by the way, for investors, all advice I'm going to give ongoing is very, very, very general. So, but generally speaking, if you're good with cash flow, you're good with paying extra, interest only is great if the interest rate is the same. But if you're wanting to know what's going to be the cheapest, that's what I'm going to help you work out. Basically, the summary of the findings is that if you have a $500,000 loan and you choose a principal and interest and the rate is 3.79, once again, July 22, could be 10, could be 1, who knows by the time you're watching this, but 3.79, you add 0.2% on top, so it's now 3.99 for interest only. It's saying that the total interest you pay for interest only in after year one is $19,950 compared to principal and interest, which is $18,792. The reason for that is because if you imagine that your principal and interest, your loan is going down, which means the balance where the interest is being paid is reducing. That's going down as well. So this interest is going to continue to reduce each year. In terms of the total amount you pay. This is a cumulative, by the way. So this is what you paid in year one. This is what you paid in year one and year two, and so on. And same here, this is a cumulative. So what that means is that interest only is going to cost you $1,150 per month, per year extra because of the higher rate and because you're not paying anything off the loan. Then I said, well, if you're paying whatever the difference in the repayment, so in this particular example, it's about $664 a month. If that money goes into your owner occupied property, so this is for the investors that have a home and an investment. If that goes into that loan, you're saving $129 in the first year, $540 in the second year, $1,260 and so on. This is a cumulative as well. If you're an investor paying and you're on a certain tax rate, so let's put 33%, for example, then the tax that you save by choosing interest only, because you're keeping that loan as high as possible for as long as possible, 380, 880, and it sort of continues on like that. So basically, it's saying that if you choose interest only and all of those payments go into an owner occupied property, and you're claiming tax on that extra interest you pay on the interest only loan, it's saying that you'll be 640 worse off in the first year, 1240 in the second, 1780 in the third, and it keeps going on like that. So, you'll see this is it starts to slow down over time, but this is 10 years into the future. I mean, most people, when it comes to a 10-year a goal, most people don't think too far beyond 10 years unless they're doing a retirement strategy. So what this is basically telling us is that, and by the way, you'll see these numbers reducing. So it's going up by 600, up by 540, up by, 5 or 480. And so it is slow, that last year. But overall, you've been losing money every single year. It's different if the tax rate's higher and you go to 45% tax rate. And the reason is because you get a better tax rebate on your. So if you imagine how it works, is you have your income, which is your rent, then you have your expenses, property management, vacancy. If it wasn't rented for a period of time, obviously that just comes out of your income, maintenance, and then the biggest one is interest. So obviously, the more interest you pay, the bigger expense you have. And what that means is if you make a loss at the end of the year, you can, general advice only, you can claim that loss against your income and therefore get a rebate. If it made a profit, you've got to pay tax. And so this is just assuming this is like what your tax offset will be. Just very rough estimate. So the higher the tax rate, the more appropriate interest only could be. And once again, this is a cumulative. So it's saying it's going to cost you 507 in the first year, 920 in the first and second, and overall you start clawing back those savings as you get into the last 4 years. And I'd imagine that if I did an 11th year, you're probably ahead. So that's assuming you're putting all of that into an owner-occupied property. If you just don't pay anything else, you just go, you know what, I'll go interest only. I'm not going to pay extra. I'm going to just chuck it in the bin, go on holidays or whatever. You don't get, you'll never claim that money back. It will never work out because you're just paying extra interest and you get a little bit back in tax, but overall you're just paying extra interest. Doesn't help at all. So those lucky enough to be on a 45% tax rate or 40 or whatever the top rate is, when I say lucky enough, no one likes paying tax, but it means you're earning good money, then interest only overall works for you. But if not, then the story doesn't look so good. Now, interest only can be good for a couple of other reasons. Cash flow. I mean, the difference is $660 a month. So what some people do, they buy an investment property and they say, you know what, I'll put $664 into a bank account. I'll just put it into an offset account. And then if something happens, I need to renovate the property, I need to do something, I'm going to access those funds. So if you're doing a budget and things are fairly tight and you're like, I just want to make sure I'm okay. Interest only could be for you. Is it going to cost you extra? Well, on the lower tax rate, probably. But from a cash flow standpoint, if when it comes to security or if things get too tough, I'm just going to sell the property and you miss out on growth on that property. Well, it might be better for you to choose interest only in that instance. General advice only, of course. But that being said, that's a pretty sort of brief summary on sort of how that works. If you're purely looking at this from I'm okay with both repayment amounts, I just want to know what's the cheapest and I want to go with that. Well, top tax bracket, it evens out after 10 years, after 11 years. Lower tax bracket, the lower the tax bracket, the worse it ends up being. So that's hopefully gives you some guide. Now, if you're staying with me, those that would sort of know more detail, if you so basically how I worked it out is you can see this balance reducing over time. Then I worked out what the interest was based on that balance, and then the difference in the interest, and then I've got the tax rate based on the interest being paid each month, and then so I've got an accumulative tax figure adding up month by month. The I've got the 3.79 interest rate here plus 0.2%. If you adjust that interest rate a little bit more, a little bit higher, so I'll go back up to the higher tax bracket. If they go to 10%, then this actually adds 0.2% over here on the interest only example. But the figure actually ends up being a lot worse. Simply, the interest being charged on that is a lot higher. The difference in the one of the big reasons is that the difference between the interest only and principal and interest repayments are actually very minor, because the interest rate is so high. The principal amount coming off is not as high. So then if you go across to if you look at then what that extra is, but let's hope that never happens. And then with the extra payment calculator, this is actually getting so imagining that your loan's a $600,000 loan, for example, on a rate of 3.5%, and then if you were to pay that $664, so that's the difference between this repayment, this principal and interest payment, and this repayment, which is the interest only repayment. If all of that goes into your home loan, it's just saying how you can actually pay that loan down over time. And it's got here a saved interest thing. So it shows you then how much you've saved. This is a month by month. And what I've done is I've just added it up to be the total interest saved here. So then I said, well, okay, this is the extra interest you pay, $11.57, minus the savings on the home, minus the potential tax savings. And that's how we work out what the actual cost is going to be. There are a couple of other reasons you might choose interest only. Okay, so one could be that you want to invest the money somewhere. So if I was going to invest the money and get a 10% return on my money, it's a no-brainer. You're paying 3.99 interest and getting a 10% return. The only thing is it's going to take some time for that to come back. So the difference in the repayment is $660. So if I put $660 into shares as an example, I'm not an investor, I know nothing about shares, I'm just using this as an example, but if you go $660 in the shares, then next month add another $660, then add another $660, and you keep building up that share portfolio over time, it's saying that as you add that, you can say, what's my return, my compound return on that investment, and then it's saying what's the actual cost of choosing interest only compound. So that's compounding. So the cost of choosing interest only is going up and up and up and up and up and up, but then the compound is going up and up, and so the actual difference between the two starts to then get a little bit closer together as the amount that you're investing increases. So if I go $660 this month, $13.20 the next month, $19.80 the next month, and that's as far as the mathematics I'm going to go, then the return's going to keep increasing each time you invest that money. So it's going to be over time, and then there's sort of a break-even point at about month 40, which is actually not so bad, but that's assuming you get a return of 10%. I mean, you probably have to be pretty good at investing to be able to get a 10% return. But hey, if you can do it, then there's a reason for you to choose interest only, because the story just keeps getting better the longer that you go on for. The other reason people choose interest only, they say, well, I want to build up my offset account so I can buy another property. Well, look. So two things. Let me open up Paint so I can do a little illustration for you. Okay, so let's say, for example, you're buying a property for and thanks for everyone that's staying with me so far. So let's say, for example, you buy a property for $600K, And then say on that loan, that loan's going to be 500,000 for argument's sake. All right, 500K. Now, let's look at the scenario in 5 years' time. So in 5 years, over 5 years, you've been putting that $664 into an offset account. So 12 months, over 5 years, it's 39,000. That, depending on, that would probably get you an investment of like, 280, 270 or something like that, if you're lucky. So probably nothing really. So what that means is you're probably going to have to borrow money against that property anyway. I mean, assuming that equity has been built. So in one scenario, let's say that you chose interest only, and so your loan balance is still 500K. But the difference is that now you've actually built, let's say, you built some equity up. Excuse my terrible illustration. You've built some equity up, so then you can borrow against this. And I've got a video that explains how equity works. So just let me know if you want me to send it to you if you don't have it there already. And so you can borrow against this extra amount. Add that to the 39,000 that you've been saving because you chose interest only, and there's your deposit for the next property. On the flip side, if you chose principal and interest, and I'll go here. If you chose principal and interest, and same thing again. Same thing again here. I'll say this is the extra equity here. You've actually been able to pay down the loan. So let's say, let's go across to here, principal and interest. So in 5 years' time, you've actually paid the loan down to 450,000. So I'll put that here. I'll say 450,000, and you can borrow that back anyway. So over here you've used a little bit of equity plus the savings. Over here, you're just using all equity. In both cases, you're going to borrow for the deposit. So it's like, well, why choose interest only in that scenario? You're just going to borrow that money anyway. Sometimes, if the property drops value, well, that money you've been paying in principal is probably going to disappear. So that's kind of a safe bet. But yeah, you probably, I guess you're buying properties, so they go up in value. So you're hoping that has grown. That's everyone's different. You can choose what feels best to you. But I suppose the thing is that if you're on a 30% tax rate and it's going to cost you, over 5 years, it's going to cost you an extra $3,000 because, or you actually only are an investor and you have no home and it's cost you an extra $6,600. What's that? A first class ticket to Hawaii? I'm not sure. I don't fly first class, but that right there is, I suppose is that going to actually be give you any value by doing that? A lot of investors or people that have been investing for a long time, they're like, oh, I always choose interest only. Well, when the rates were the same, that was always a really, really handy product to have. But where the rates are different, this is just a bit more thinking to go on, and it's your money at the end of the day. You're the one spending $6,600 in interest, so you're the one that has to make sure that it works for you. I think that's everything. As with all our spreadsheets and stuff, I can send this to you if you want. It's nothing special. It's just a lot of data garble, but hope this really helped, and any questions, always let us know.